Recording in progress.
Okay, Zoom crew, can everybody hear me? Somebody give me a, Ryan, okay, great, thank you. All right, I'm gonna try to share my screen here. Okay, I think I'm all set up. 2 minutes late, but that's all right. We got a quick lecture tonight. We're moving into the forecasting of financial statements tonight. So we spent the first 10 weeks going into different aspects of accounting and working on the generally accepted accounting practices, estimates, and so a lot of time really focusing on where management has an opportunity to influence that accounting one way or another, and how we, as analysts, need to know how the accounting works so that we can make adjustments where necessary. Sometimes those adjustments are based on peer-to-peer comparisons. Sometimes those adjustments are just based on what we believe to be a better representation of the economic reality. And that's where the analyst skill set comes in. And that's the first 10 weeks of this class. And tonight we're going to pivot. And we're going to pivot into taking all of that knowledge that we've accrued and applying it. And the application is where you see the title of our text is Financial Statement Analysis and Valuation. Well, the first 10 weeks were analysis. Tonight starts the valuation. And the first step of valuing any business is to understand what the cash flows look like today so you can forecast them into the future. Financial theory would suggest that if we know with certainty what the cash flows of a business are going to be in the future, well, then we can value that business and put a price on it. That probably sounds a lot like what you learned in your first intro to finance classes. And as you move into investments, typically somewhere in that journey, you're exposed to a discounted cash flow analysis. And we're going to do one of those in this course too. But the first step is to forecast the financials into the future. So module 11 is a very basic overview of how we begin to do that. And I'm going to take you through the slides tonight and expound a little bit on what the authors share with us in the text, give you an opportunity to ask questions. But for the most part, it's pretty straightforward material that I don't think you'll have a problem grasping. And we may even get out of here a little early tonight. But before I launch into lecture, hit me with any questions about homework, exam. It's been a couple weeks since we met. How's everybody doing?
I may have missed something like 2 weeks ago when I bring my class, but was there ever like a resolution to the like Thompson one situation? Is the solution now just to go straight with Bloomberg?
The solution is to go straight with Bloomberg. Yeah, and for everybody on Zoom, the question was, what happened to our Thompson One access? And the university, I don't know, they discarded it. They decided that it wasn't part of what they wanted to pay for the students anymore. So I complained with Dr. Clark. That didn't get us anywhere. So our only solution is Bloomberg. Yeah. So he was a little disappointed too, but it sounded like it was out of his hands. I think it was budgetary concerns. So, and Morningstar, if you remember all the way back to the first and second class, one of my pieces of advice when you were selecting your company was to look at one that had good Morningstar research. So go to Morningstar, get that research. Typically, they do a very good job of laying out their research reports. Almost
question on the Morningstar research reports. It seems like the analysts will write one and then sort of make updates to it. Is that how that works?
Yep, typically that's not uncommon. Even when you pull up a research report from Morgan Stanley or Merrill Lynch or one of the major brokerage houses, What you'll want to look for is the report that's dated as of the initiating of that coverage. That's going to be the most expansive. And then after that, you'll typically get updates. So you might have to go back 12, 18 months to find an original work that's of any length, and then print off all the updates, and you'll have a pretty good starting place. Okay. Yes, ma'am.
On the DCF model that you uploaded online, for some of the stuff on like the share price and whatever, do you want us to wait till further on to actually like put all that data in and do all the calculations?
That'd be great, but it's a little too much to ask. I understand how your semester unfolds. So anything from this point on is recent enough. You know, we're in the back third of this class, and you got what could be a 50, 60, 70 page research report to write. Yeah, now is sufficient, but great question. In the past, I've had some students select companies that announced a big merger or acquisition during the semester. And if that happens, as you know, that completely changes your analysis. I mean, if it's a sizable merger, it doubles the amount of work you have to do. So if anything like that has happened during the course of the semester, just ping me and I'll give you some guidance on that. I don't expect anybody to have to write 2 complete research reports to understand what a company's valued at or what it's worth. And as you get into these research reports, recall that we've laid out the semester in a way that is supposed to give you time at the end of the semester to compile all this. So the second exam window closes tonight. Imagine most of you have taken that or will take it tonight. Probably wouldn't be here again taking it again. And then the third exam will comprise modules 9 through 12. We'll cover 12 next week. We'll open that exam, and then that effectively ends our semester as far as the exams and homework is considered. And we'll spend the next 3 weeks working on these research reports. I'll still lecture a little bit, but I'll move quickly through the material so that we can leave some time at the end of class to really workshop these and bring it all together. What else? Okay. Well, interrupt me at any point and we'll just jump into it here. Okay, let me see if I can get rid of this thing. There we go. Okay. That's workable. Okay, explain the process of forecasting financial statements. So what we want at the end of this exercise is to have identified where all of your companies that you're doing work on, where they are today. So you'll have financials that post through 2020. You probably don't have 2021 financials yet unless you had a fiscal year end as of June 30 or something like that. So we want to take 2020 financials and forecast what we believe is the best representation of 2021. And then we want to go 2022 and we want to create a 10-year forecast. Now, 10 years, that's ambitious. Realistically, what we're going to come up with is the best case representation for next year, and then probably some reasonable growth rate into years 2 through 3. A lot of times these unfold where you have what's called a semi-step growth model, where you'll be analyzing a company, maybe it's a startup or a young tech company, and for a period of time, they have accelerated growth. So maybe year 2, 3, 4, they're growing at a nice clip, 15, 20, maybe 30%. But then somewhere in your forecast horizon, that growth rate is going to compress to mid-single digits. So we use a 10-year forecast period, and hopefully you will have gotten some guidance from management or Morningstar or some other analyst report that you pulled off Bloomberg. The place you want to start is with management guidance. You're working through all of these research databases, you've compiled all of this information on the companies that you're working on. And somewhere in there is management's comments about what they think the business will do. You're gonna want to look in what's called the MD&A section of the quarterly reports and the annual reports. That's management, discussion, and analysis. We reviewed this, I think it was in night 2, but if you're like me, everybody can always use a helpful refresher. The easiest way to find this is to go to the investor relations website of your target company. So if you're working on Walmart, go to Walmart Investor Relations, and they typically have this all nicely, neatly packaged. There's probably going to be a PowerPoint presentation out there. I wouldn't be surprised at all if somewhere in that PowerPoint presentation, you got a few slides that said management guidance. That's where you want to start when you're pulling together a financial forecast, is with management guidance. And then the research report that you're all working on is going to reference management guidance. And maybe you have high confidence in your management team. They're people of high integrity, and they've been very accurate in their prior forecasts. And you have no reason to believe that they won't do and deliver on exactly that. Makes your forecasting process pretty easy. Alternatively, maybe you're dealing with a management team that likes to sandbag. They like to give you numbers that are a little bit low, so when they report their earnings, the stock gets a nice little pop. One of the first projects that I worked on as a young analyst was United Technologies. And at the time, United Technologies had a reputation for sandbagging. And they would brag about this. They would say that they had successfully beaten Wall Street expectations. I think it was like for 30 quarters in a row. That's 7 years or so more, which is impressive, but nobody can do that unless they're participating. So every quarter they would make forecasts and convince the Wall Street community that their earnings were going to be lower than what they really were. And then they work like hell to make sure that those earnings posted higher than Wall Street expectations. And I think over time, what we observed was that they were monkeying around with some of the accounting. So we know the accounting, we know the management team, we've been monitoring their guidance for several quarters. We know whether or not they typically hit it, and we're going to be able to make an assessment about whether or not we believe their guidance. So as we pull all this together, what we're going to create is an income statement, a balance sheet, and a statement of cash flows for the next 10 years. Now, in practice, the income statement is the most important. As an analyst trying to figure out what a company is worth, the income statement is really going to tell you everything that you need to know. It's going to identify those cash flows that we will use to discount back to time zero at all. That discounted cash flow analysis will cover in module 13. So I won't go into it tonight, but those cash flows tell us what a company's worth. We don't necessarily need the balance sheet or the statement of cash flows to do that, but those three statements together articulate. That's the word that accountants use to make sure everything quotes and crosses. It all adds up, it makes sense. Assets equal liabilities plus equity. So we will forecast a balance sheet and we will forecast a statement of cash flows. Just know in practice, a lot of analysts stop at the income statement. But it's a really good exercise to go ahead and go through the balance sheet and statement of cash flows, because if you've made a mistake, that's where you'll find it. Things won't balance, they won't tie. Your historical relation between cash and sales and other assets might be a little bit off. So I think of that as, I call it passing the smell test. Does everything smell right? Does it look right? Is it consistent with the history of the way a company's operated? Okay, on slide 4 here, our authors remind us that what we're concerned with is the future cash flows of the company, which means we as analysts have to adjust for anything that's not germane to future operating cash flows of the business. And there's all kinds of things that fall underneath those categories. And we've touched on several of them this semester: restructuring expenses, litigation expenses, discontinued operations, so on and so forth. Hopefully, at this point in the class, you can differentiate for yourselves what's likely to be recurring and what's not likely to be recurring. And then we just pull all that out. Now recall that I have a rather skeptical view on management's use of these items to try to segment off things that they want to convince you won't recur in the future. Due to bad decision making, or mergers and acquisitions, restructuring expenses. Look at the history of your business. Does your management team have a consistent track record of reporting restructuring expenses quarter after quarter after quarter after quarter? Some of these things are not really non-recurring. Some of these things show up repeatedly, and if they do, adjust for that. Ding your management a little bit when you're forecasting the cash flows. Just think through that with a little bit of a skeptical eye. I made some notes on these slides. I just want to make sure I don't shortchange any of them. Okay. The forecast will always start with top line revenues. And top line revenues are going to drive most of the other line items on your income statement. If you look at most businesses, and I tried to make the list that we all choose from consistent with this, revenues drive all of the expenses. The more revenues that we have on our income statement, the more cost of goods sold we're going to have. The more selling, general, and administrative expenses. If you go through an income statement, most of the expenses that you see on the income statement are in relation to sales. We can calculate them as a percentage of sales, which is exactly what our authors are encouraging us to do when we forecast all the expense line items. So revenue is crucial. And I expect that most of your management teams will have some revenue forecast. And if you're dealing with a company like, I just used the example of Walmart, well, you have a very lengthy track record to go back and look at their historical growth rate. A company like Walmart's probably been growing at 3 to 5% for the last 2 decades. Pretty safe bet they're going to be growing at 3 to 5% for the next 10 years. That makes for a pretty easy forecast. Now, if you're looking at a company that's a little bit younger or a faster growing industry, there's a lot of subjectivity that can come into that, especially if there's been mergers and acquisitions in the past few years. You might have to really dig around and consult some analyst expertise to get a handle on what you think that growth rate is going to be. But once you have it, you can expect all of the other income statement line items and even the balance sheet line items to flow from that one single estimate. And as you compile these forecasts, what you're going to want to do is create a sensitivity analysis. So I'm jumping ahead a little bit, but after you get the income statement, balance sheet, cash flow forecast, you want to recognize what your most sensitive inputs are. Certainly revenue and revenue growth rate is going to be one of the most sensitive inputs. So do a bull case, do a bear case, do a base case. That's how we always do it as analysts. Your base case is what you believe to be true. Based on all of the information that you've gathered this semester, you're going to create a base case. After that's done, you're going to do a sensitivity analysis and say to yourself, well, okay, what happens in a bull case? What happens in an optimistic scenario? Maybe your base case is that Walmart can grow at 3%. Well, in an optimistic scenario, maybe they grow at 4 or 5. Run a new discounted cash flow with a higher revenue growth rate and see what the valuation of Walmart would be under different circumstances. Now, if it's a tech company, your base case might be 10, your bull case might be 20, and your bear case might be 0. There might just be that much variability in the cash flows of some of the companies that we're looking at. Okay, next slide. 2 important points to make. I already mentioned the first one, which was internal consistency. We forecasted 3 statements so that we can make sure everything ticks and ties. Second point on this slide is important, level of precision. It's important because I'm trying to save you headaches. And as an analyst, We touched on the concept of materiality several points in the semester already. And it's up to you as the analyst to be able to recognize what's material and what's not material. Same thing with level of precision. I remember as a young analyst, I was working for the Buffalo Funds, and I got tasked with doing a write-up on Boeing. It's actually a team of us. I think there were 4 of us at the time. And we got into this really wonky conversation about the value of Rocketdyne. And Rocketdyne was a subsidiary that Boeing owned that did work for NASA. And it was starting to get a little heated, and I don't remember who the disagreement was, but at some point we just had to call a timeout and recognize that Rocketdyne was less than 2% of Boeing's total revenues. Didn't matter what our disagreement was, because it wasn't material. It wasn't, the level of precision just wasn't there. I could have been right, my colleague could have been right. Either way, the decision that we were trying to make about whether or not Boeing stock was a value at the time was irrelevant. So my advice to you is that you recognize this concept called level of precision, and inside that conversation, certainly your revenue growth rate will absolutely be material, but something that's particular to a smaller subsidiary or a lesser line item might not be material, and therefore you as the analyst can basically ignore it. Here's an example of what you're likely to see when you go grab that investor relations presentation. Our authors are using the example of Procter & Gamble here, and you can see Procter & Gamble for 2020 gave guidance of sales growth of 3 to 4%. That was for organic, and all-in sales growth was 3 to 4% too. So the analyst here decided to split the difference, and they used a sales growth number of 3.5%. So last year, your sales were 100,000, and you're going to use a sales growth estimate of 3.5%. That makes next year's sales 103,500. Pretty easy stuff. And I think as we move through the forecasts for the rest of the income statement, those are going to be pretty easy as well. So next slide here, Procter & Gamble is giving guidance on capital expenditures. You can see that their free cash flow productivity is 90%. Capital spending to sales is 4.5 to 5. So we just forecast sales. Now management is giving us an expectation of capital expenditure based on sales. So just like I mentioned a moment ago, most of these flow from sales. After you get that one item figured out, you're going to see that it just kind of cascades down. Now, for 10 weeks into the semester, you've done a lot of work on these research projects. Maybe you're going to be cramming from here on out in the semester. It doesn't matter. You're going to figure a lot of things out. And you may come to the conclusion that some of these line items don't have a direct relationship to sales. It's your job to know that. I think you're going to find that most of them do have a direct relationship to sales, but it doesn't apply to everything. You can also see we get guidance on dividends. We get guidance on direct share repurchases. A lot of the companies that you're looking at now have purchase share programs in the marketplace where they have announced to investors that they intend to repurchase tens of thousands or even hundreds of thousands of shares over the next few years. If so, when you forecast your balance sheet, you're going to have to reduce the number of shares outstanding. And if you reduce the number of shares outstanding, you're going to have to lower your cash balance because they're buying those shares back with cash. That transaction needs to be reflected as you forecast financials out into the future. And that will similarly affect things like debt to equity ratios and return on equity and so on and so forth. So I didn't mention that, but as you forecast your financials into the future and you're building this big spreadsheet that drives it all, you're probably going to set it up so that you have historical financials to work on. And underneath those historical financials, you've probably done a ratio analysis. you have margins there, you have net operating profit after tax, you have net operating asset turnover. Everything that we've studied in this class is driven off the same basic spreadsheet. And most of that information is a direct download from Morningstar. So as you forecast these financials from historical and the future, go ahead and just drag over the ratio analysis. So that you have all the ratios, you have all the margins, you have all the net operating asset turnover. I don't need to teach you how to do Excel. That's just an easy drag across for most of you that have spent any time in that program. Okay, next slide number 10 here. You can see that our authors are continuing on with that same basic analysis. Cost of goods sold is forecast as a percentage of sales. SG&A is forecast as a percentage of sales. One-time items are discarded. Income tax is as a percentage of pre-tax income. So not directly linked to sales. Go back, look, last year, we talked about this. I think it was module 9. There's a disclosure in the back of every 10K filing that shows what your company paid as an effective income tax rate. So unless you have reason to think that's going to be different this year than it was last year, use the same tax rate. So if the tax rate was 30% last year, then you're going to take 30%, multiply that times the pre-tax income, get your taxes. Pre-tax income less taxes equals after-tax income, and just kind of moving your way down the income statement. Slide number 11 is a terrific slide. Star this one. I want you to do something similar for your research projects. As you're moving down through the income statement, create a column. So you have column A, you have all of the accounts. In column B, you have actual 2019, actual 2020. In column C, you have the computation that you're using. You know, how are you forecasting? Then in column D, you have the 2021 estimate. And then in column E, you have the notes that you used to justify that. And with Procter & Gamble here, you can see that most of these net sales, they used management guidance. Cost of products sold, they used a percentage of sales. Same with SG&A. Interest expense, we just talked about that. No, we didn't. We talked about tax expense. Interest expense is basically the same. You're going to be able to calculate from prior year's numbers what the interest rate was. So you know how much debt they had outstanding. You know how much the company paid in interest. With those two items, you can compute the interest rate, 4%, 5%, 6% is what they're paying on interest. That's likely going to stay the same. To be able to make that determination by reading the footnotes associated with last year's interest rates, but for the sake of argument, let's say it stays the same. You can use that, multiply that times the debt outstanding, and you have your interest expense. You can kind of see how these things unfold, and before you know it, you have a forecasted income statement that you're working with here. Slide number 12 shows us an example of management's discussion and analysis. Go ahead and copy, cut, paste this MD&A section directly into your research report. There's no reason that you have to make this harder than what it is. If management's doing a relatively good job of giving you guidance, then just cite it. And that's probably a good reminder for everybody in the room. These research reports are not meant to be a lot of original work. Just find the source documents, cite the source documents, drag them directly into the research report. It's the executive summary where I want to see a little bit of your kind of analytical and executive thinking. You summarize how you went about it, summarize why you chose to agree with management's discussion analysis, summarize any points where you might differ or disagree, cite Morningstar, cite any other research reports that you have. The whole project is really an assimilation project, a compilation project, more so than an original work, although I don't want to discount the process as a whole because that is something of an original work. Okay, word to the wise or heads up on slide number 16. Our authors are giving us a little bit of a precaution about Procter and Gamble here in October of 2005 acquired Gillette. Gillette was a huge purchase for Procter and Gamble. I think it was about a third of their existing size, which means that any of their published numbers would have looked like Procter and Gamble grew by about 30% or 20% growth rate. Obviously, a company like Procter and Gamble is not going to grow by 20% organic. That has to be M&A. What's the likelihood that that M&A activity is going to occur? Very, very low. It's going to take them a few years to digest an acquisition like that, or they could potentially go out and buy another or some other big product brand. So when you see an instance like that, if your company has mergers and acquisitions on its books, it's your job to make the appropriate reconciliation. They can't grow 20%. That's not reasonable. So go back and look at what their historical growth rate had been, sans the Gillette acquisition, and come to some conclusion if that might be a more reasonable place to start for a company like Procter and Gamble when you're trying to forecast their sales growth. So our authors did exactly that on slide number 17 here, and they come to the conclusion that sales growth is probably more reasonable in the range of 4.5%. I took Gillette out of the equation and get the difference between 05 and 06 there. Sales growth amounted to 4.5%. Same story for divestitures. In 2009 or 2010, Kraft spun off another company called Mondelez. We looked at spin-offs and split-offs and other corporate transactions a few weeks ago. And if you see something like that, also know that your financials are going to be affected like that. So any year-over-year comparisons are going to be misleading. Okay, let's look at the balance sheet. Just like sales drove everything on the income statement, some of the balance sheet will be linked to sales, but those items oftentimes have a more direct driver, which you'll see here as we look at these accounts. Let's just go through slide number 20, bullet by bullet. Working capital accounts can be forecast as a percent of sales. Working capital are your current assets, your accounts receivable, current liabilities, your accounts payable, cash on hand, inventory on hand. Makes a lot of sense that those line items would be relative to sales. If you're going to sell more, you have to have more accounts receivable, accounts payable, so on and so forth. So working capital, forecast that as a percentage of sales, look back over time, see where it's been and forecast. Property, plant, and equipment. We talked about CapEx. This is a very common piece of guidance that you'll get from your management team. If you don't get specific CapEx guidance, look back at the history of your firm, see how much they've been spending relative to property, plant, equipment, see how much they've been spending relative to sales. You can come to some conclusion that way. Intangible assets, you're going to subtract the amortization expense. That's generally pretty straight line, kind of like depreciation. So that's an easy one. Current and long-term debt. We know from the disclosures in the back of the 10K that the long-term debt is divided into short-term and long-term, and the mandatory cash flow payments for the next 5 years have to be disclosed. So, upcoming slide here. But if we have $10 million in long-term debt, you may see in the back of the 10K filing that $2 million of it has to be paid next year. Okay, well now that makes forecasting the balance sheet pretty easy. We know next year the $2 million of that is going to come off, and our cash is going to have to decrease by $2 million in order to pay that debt off. Now, what happens if we don't have the cash? Where does that $2 million go?
Finance.
Yeah, it's, first off, it's a good question for management, but if you look back at the history of a lot of businesses, that's exactly what they're gonna do. They're just gonna go get another $2 million loan from the bank, and pay back the loan that's due with newly borrowed money. That's called evergreen debt. We covered it earlier in the semester. It's a strategy of financing debt with new debt. Companies do it all the time. In doing so, what you're typically going to see is that their debt to equity ratio also stays constant over time, which is a just fine way of running your business until it's not a just fine way of running your business, because a liquidity crunch can really make you pay for that type of strategy. We saw that in 2008, 2009. Notwithstanding, it's very common, and you may see your managements utilize that strategy. And if so, I would expect that to also be disclosed in the MD&A section. Okay, stockholders' equity. We talked a little bit about treasury stock. Usually those treasury stock programs are announced in advance. If they are or have been announced in advance, then all you need to do is plug that transaction into your balance sheet. Management intends to buy back X number of shares, factor that in as you forecast that balance sheet. And then lastly, dividends. Dividends are one of the most stable items year over year over year over year, because companies really don't like to cut dividends. Investors have a knee-jerk response to the negative, to the downside, when a company cuts its dividends, because if you own GM or Procter & Gamble or Boeing or Ford, these are all dividend-paying companies. Most of the time, dividend-paying companies are held by investors who want that dividend. They probably, a lot of them live on these dividends. So if a company cuts the dividend, what do investors do? They complain loudly, and then they sell the stock. And when they sell the stock in mass, that stock typically takes a dive and goes down. So management teams are want to cut the dividend because they know that they'll get punished for it. Okay, I'm skipping through a couple of these slides because the authors give us examples of all these, but they're very simple and very straightforward. So if you want to use them as a reference, please do so. Otherwise, I don't expect you to have trouble with any of this. Yeah. Okay, I do want to talk a little bit about cash. So there were 6 or 7 slides that I just kind of moved through there, and they were all a little bit more expansive on those 6 bullet points that I just did, but still very simplistic in nature, so you won't have any trouble with it. Cash is a plug figure. After you forecast everything else on your balance sheet, you go back to cash, and we know that assets have to equal liabilities plus equities. Well, we know what the liabilities plus equities are, and we know what the remainder of the assets are, everything except for cash. Cash now becomes the plug figure, which forces the balance sheet to balance. Easy. The only nuance to it, or the only wrinkle to it, is that it becomes your job as an analyst to eyeball that, and I use that term smell test as a smell run. So go back through history and look at cash relative to other assets. Look at cash relative to debt. Look at cash relative to sales. Is it still trending about where you expect it to be as an analyst? You don't want to get to this point in your forecasting process and have cash look like an outlier. That ought to be a little bit of a pink flag, or a little bit of a reminder that something might be off. So that would cause you to kind of go back and revisit all your forecasts, make sure you don't have growth rate that's too high, make sure you don't have margins that are too high. Or maybe you do. Maybe cash is high for a reason. Maybe you've taken a very bullish opinion on the company that you're looking at, and you think they can blow the doors off with regard to their sales, or they're about to, I don't know, open open up a new manufacturing facility that's gonna be a lot more efficient. And the efficiency inside that manufacturing facility is gonna drive margins. And those margins are gonna drive higher productivity levels. And those higher productivity levels should leave a lot of cash on the balance sheet. Have to know that story. If you end up with a lot of cash on the balance sheet and you don't know the story, you've probably done something wrong. If you end up with a lot of cash on the balance sheet and you do know the story, that's just an indicator of exactly what you think is gonna happen, and give yourself a pat on the back. So it's the story that really matters. And if you can tell the story, you can write a research report that is coherent and ties all this together. So just like we did with the balance sheet, I want you to put together a table that looks like this, just like you did for the income statement, excuse me. I want you to put together a table that looks like this for the balance sheet, where you take last year's numbers, you look at how you have forecasted those in the future, you have a little column that shows the computation, and then you have a column to the far right that shows any assumptions that you've used to forecast those in. And P&G here is using everything that we basically just talked about. They're using a plug for cash, they're forecasting working capital off sales, they're taking management guidance for CapEx, they're using the footnotes for long-term debt, et cetera, et cetera, et cetera. Okay, learning objective number 4. You are going to see this because it's very common for conglomerates, and Procter & Gamble is a good one. Procter & Gamble is a consumer brands company, and it's so huge, you'll find them giving guidance down to the individual brand level. So they may give guidance for home goods. They may give guidance for, well, let's see, I think they're just listed. Okay, here's Procter & Gamble's major divisions: beauty, grooming, healthcare, fabric and home care, baby, corporate, total company. I don't expect anybody in this room to go into that level of detail, but you might see 1 or 2 questions pop up on the homework or the exam, because this is very common when you get to looking at that company's individual financials. And if you do see this, you're also likely to see guidance on each of these segments. So a Wall Street analyst that does this as their real job, they may have models built out for every single one of these segments. And those models might be very complex and detailed, and they all sum up to the company level so that they can make some assessment about what Procter & Gamble's worth. You'd see the same thing for Berkshire Hathaway.
You know where you'd be able to find that segmented income statement? I haven't seen it, and I just see statement on Johnson & Johnson.
Oh,
You said it's that operating period and then
yeah. I don't know how J&J works. This stuff is not GAAP, so they're not required to disclose it. And J&J just might not, which
I've seen revenue for a second, but I haven't seen anything else that you find.
have you,
I haven't
sifted through their 10K yet? Okay. Have you looked at any analyst reports?
I've looked mostly at Morningstar and a couple other things just online.
Okay.
But I haven't, because I feel like that'd be pretty valuable for Johnson & Johnson. Since other than pharmaceutical segment,
Yes.
60% of sales.
Well, so you know that much. So that's where you start. But I would suggest you use Bloomberg, and then have you gotten all of the reports that you can find on the investor relations site? Okay, try those 2 sources and see if you get any more detail on the segment breakdown. And then if you're still struggling, let me know, and I can probably help come up with some more ideas. Here's an example of Morgan Stanley. So if you're over on the Bloomberg, this is how Morgan Stanley breaks down P&G. You might see something similar for Johnson & Johnson. So they take each of these business units, apply an organic sales growth number, and aggregate all that up. again, and I want to make sure I'm clear about this, that's not expected of your research project. This is a little bit outside the scope of what I would expect of this class. But if you want to go into that level of detail, that's terrific. Okay, lastly, the statement of cash flows. Once you have the income statement and the balance sheet, forecasting the statement of cash flows is no different from preparing the statement of cash flows. So if you think back to your first accounting class, I know that you all at some point in your career have pulled together financial statements. And if you recall how you pull together the statement of cash flows, you're working off an income statement and a balance sheet. Well, forecasting the statement of cash flow is nothing more than the exact same process, working off the forecasted income statement and balance sheet. So this ought to be 100% review, although depending on how long it's been since you took that intro to accounting class, the review might be appreciated. So here's how you create a statement of cash flows. You start with cash from operating activities, which is net income. And you all know that net income is not a cash number. Net income is an accrual number because we make all kinds of adjustments to match the revenues that were generated in a specific period against the expenses that were generated in a specific period. And neither of those are necessarily cash items. We have a whole chapter on revenue recognition and another whole module on expense recognition. That's what shows up on the income statement. The statement of cash flows reconciles those terms because we have to know that how accrual accounting affects that. So you start with net income, and then systematically you just add back all of the non-cash items or subtract the non-cash items, beginning with depreciation, non-cash, amortization, non-cash, change in accounts receivable, change in inventories. Those are both working capital accounts, and those changes represent an increase or a decrease in cash. So as you move down the changes in your balance sheet items from accounts receivable to inventory, accounts payable, other liabilities, you get to net cash from operating activities. After net cash from operating activities, you're going to move into the investing section. So you'll subtract out capital expenditures, which is that's a balance sheet item. Change in available for sale securities gets you to net cash before investing activities. And then your investing activities would be things like dividends, increases in short-term debt, increases in long-term debt, so on and so forth. I have never seen this done in practice. This is almost purely an academic exercise. I'm going to make you go through it because you all need to know how it's done. But then once you graduate and get a job, if you get a job in the investments industry, and this is of any relevance to you at all, I never forecast cash flows or analyst. Still don't. I stop with the income statement and the balance sheet. And for the most part, that serves me very, very well. Could I have avoided a few mistakes by going through the extra process of forecasting a statement of cash flows? That's entirely possible. And I want to make sure that everybody in this class knows how to do it. And it may serve to be illuminating. And then you can decide whether or not you want to use that when you get out into your paying gigs. Okay. So I just talked about what analysts don't do, which is that last step, the statement of cash flows. Most of the time it's neglected. I don't see it. What I do see are shortcuts, all kinds of shortcuts. And the parsimonious method is perhaps the simplest and biggest shortcut that you're going to find in anywhere in our industry, and especially for this exercise. It's nothing more than saying, all I need to know are sales growth and margins. You know, sales growth, you can forecast top line revenues. And then if you know margin, you can forecast bottom line profit. If you have bottom line profit, you can do a discounted cash flow analysis. So the parsimonious method puts a lot of emphasis on sales growth. Take a deep dive into management expectations, historical sales, new sales strategies, so on and so forth. You have to get that number right. And then same way for margins. If you've ever done any work on Intel or semiconductor stocks or a lot of tech companies, gross margin is everything. Gross margin drives company value. It's very common for those analysts to use a shortcut method or a parsimonious method that is heavily weighted on gross margin to drive the value of a stock into the future. So that's super easy, really nothing more for you to know there than it's called the parsimonious method. And if you're asked to use the parsimonious method on an exam or in your homework, just know you need right here, this slide number 45 is your playbook. And it starts with top line sales growth. So if you have top line sales growth, then sales is a very easy thing to compute from that. And then if you know sales, you can calculate your net operating profit after tax from your net operating profit after tax margin. And then you have your bottom line number. Okay, that's it. That's module 11. I moved through it very quickly because it is simpler material, and after modules 9 and 10, feel like you probably all feel like you deserve something a little simpler because those were heavy accounting. So that's my lecture for tonight. I'm going to put about 20 minutes back in your day, unless I can answer any questions for you. Zoom crew, you guys good?
Good.
Yeah.
All right, I'm gonna stop the share, and I will post next week, sometime next week, I will post the third exam. So the lecture over module 12 is recorded, and I will post that third exam. You'll have another 2-week window to take it. Let me know if you have any questions, and I'll talk to you in a couple of weeks. Thanks all.
Thank you.